You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, that music means it is time once again for Education Wednesday here on the old Options Insider Radio Network. That means Options Bootcamp coming at you hot and heavy here, live on the old Options Insider Radio Network. If you need your double dose, stay tuned. A little bit later in the day, you're going to get good old Options Playbook Radio live to tape on that one, so that'll be coming out on demand only. But you'll get them, of course, both on the full network as well. If you feel like joining us here, usually tend to record the old boot camp around 2 o'clock Central on Wednesdays, so keep that time slot open in your calendar there, listeners, if you want to join myself and the black-hatted one live here, as well as special guests and all sorts of fun. So we tend to bump the live folks up to the top of the list if you have a question, including a day like today when we have a whole bunch of questions to get to. Remember, if you like what you hear, do what a lot of our listeners have done. Head on out to your platform of choice. Leave a review. The more, the merrier out there. Helps folks continue to discover this program and indeed the full network in these troubled times. Of course, you can leave them anywhere, Apple Store, Google Podcasts. You can go on the App Store for both of those major platforms as well. Our app is available there. I know a lot of you like to get our content that way as well. We don't judge. However you listen, leave those comments, leave those reviews. Preferably 5 stars, but hey, whatever floats your boat out there, so new folks can continue to discover the program. Let's see who we're going to hear from today. Looks like it is, yes, indeed, once again, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, by way of a few options-oriented tomes, by way of back in the dark days of the SIBO as a market maker, by way of, I'm not sure wherever he was born. We can go back as far as we want. Mr. P, welcome back to Options Bootcamp, sir. How far back should we go? Way back in the dark days of whatever year Mr. P came into the world, sir.
Those early 90s, yeah.
Early 90s? I was early 2000s myself, so you beat me by like a decade. I'm a millennial, didn't you know? Oh, good stuff. All right, let's see how many millennials we have in the audience, as well as a bunch of the rest of you, as we head on into your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the mail call, the portion of the show where we answer your questions. You guys have a lot of them these days. Every now and then, Dan and I take time out of our busy schedules to answer a whole bunch of them, so you guys can go away happy. Let's kick things off, as we are wont to do in these troubled times, with a little bit of love. This one coming in the way of a 5-star review. I'm not sure what platform. It might be iTunes. I'm not sure what platform this came from. This is from Alan TPA. He says, very educational, ! Great show, very educational and easy to understand. Keep up the good work. Yet another ! Well, thank you for that, Mr. Allen TPA, and everyone else out there who took the time to rate and review us on your platforms of choice. The show's been running for a long time. Our network has been running for a long time. But again, these views do help help new people, particularly in this troubled time, to discover the show. So get on out there if you haven't done so already. Leave those reviews. Mr. Dan, what do you think about your good buddy, clearly? Mr. Allen TPA likes the show. He calls it very educational, exclamation points.
There's nothing I love more than exclamation points, Mark. You know that. You know that to be true.
You are very much in the exaggerated exclamation point camp.
Yeah, and that's the objective, man. Boot camp is intended to be educational. That's what it's for. And I believe, and I know Mark believes too, that knowledge is power. That's the best thing that you can get for yourself. And we love to be able to share our little corner of the world with you.
Wasn't that the name of your first band back in the day, the exclamation point?
Yes, but it was just the symbol. It was just an exclamation point, so nobody knew how to pronounce it, so we flopped.
You beat Prince to that punch, just a symbol. No name for you guys. Just like, what is the name of that band? I don't remember, but it looks like an exclamation point. Yes, that's where all the tongue started wagging about Dan P. and his musical career. Let's see what we got up next. I like this handle, Meets with a Z. Meets with a Z wants to know, what do you expect to happen in the options market if we don't know who the president is after November 3rd? Well, a lot to unpack there. By the way, if you are interested in such things, I know a lot of our audience, including Mr. or Mrs. Meets, is, then stay tuned. On November 3rd, we're going to be having a fun live show in the late afternoon, early evening. So you're talking probably starting around 6 p.m. Central, and then going on through for at least 3 hours, maybe longer, depending on how things unfold out there. Don't worry if you're saying, I want to divorce myself from politics. I get that other places. We know that. You're not coming to us for politics. We're not going to give it to you. We're not going to say this candidate is good, this candidate is bad. We're going to talk about the returns and how they're impacting the markets and all things financial. As you recall, back in 2016, a lot of things popped off that night as a result of the surprise results for a lot of people out there. So we're going to do that again this year. Should have a great cavalcade of guest stars joining me. Mr. P, are you down for that? Are you going to join us on our election night special, sir?
I am. I might end up showing up a little bit late, but yeah, I plan on being there.
Good thing it runs for 4 hours, so I think we can find some time to squeeze you in. All right, back to the question from Meets. What do you expect to happen in the options market if you don't know who the president is after November 3rd? Well, we do have a few analogs for this. First off, I was back on the SIBO back in the heady days of Bush Gore in 2000. Maybe Dan was as well. And that was something to behold. The market swung day after day. We had those images burned into our brains of people staring there, looking at the hanging chads with magnifying glasses and analyzing that. And whichever way it seemed like the chads were swinging, the market would swing. And that was a lot of volatility. I don't think anyone wants a repeat of that. If you're worried about that, looks like about 3 weeks to a month ago, the market was really pricing in a lot of consternation post-election. If you looked at things like, let's say, the VIX futures term structure, for example, seeing how much volatility is being priced into the market in the election and beyond, they were pricing a lot of volatility through the election and indeed beyond it. So into November, later November, into December, and even into January. That was what was a little bit disconcerting to me. They were pricing in a pretty healthy premium through January, and that seemed like maybe they were pricing in a lot of uncertainty. It seems like post-debates and maybe post-coronavirus diagnosis and whatever else is driving this, it does seem like the market appears to be coalescing around the fact that Biden is probably the front runner, and we're probably going to have a good handle on who the winner is post, even that night on election night, because they are starting to take some of that juice that they've been pricing in for, the latter months, later November into December into January. Some of that is starting to come out of the marketplace now. You could argue that maybe that's premature. We saw that with Brexit. We saw that in 2016. It started coming for the vol a little bit too early, and surprise, surprise, things took off in the opposite direction. So you could make that argument, but still, they are coming for it. So based on what we're seeing right now, I don't think we're going to see a lot of tumult. But let's say the worst happens, Mr. P. Let's say it is one of these contested elections. A, were you down there on the SIBO for the heady days of Bush Gore? And then B, as Meets wants to know, you think we're going to see a repeat of that, sir?
I was down there then. Interesting. And we probably will see some of that. If you look at the term structure now, the volatility term structure now, there is a higher volatility after November 3rd by about a couple of points, fairly universally. But I mean, just look at the spiders. And that 2-point bump in volatility stays there for like a freaking year. You go out to January of 2022 and you still see elevated implied volatility. So, I think there's a lot of uncertainty. Some of it is already priced in. And, the thing with the market, buy the rumor, sell the news, when it looks like, I mean, it's kind of telegraphed already that it might be a contested election. So that being said, I don't know. I think some of the volatility is priced in, and it might turn out to be less of an actual market moving event than we think, because I think we already know we're not going to know.
I was with you. I was thinking that probably like a few weeks ago. It does seem like the market is getting a little bit less uncertain now. So I have a ray of hope, a glimmer of optimism that we won't have this dire scenario that Meets supposes here, that we're not going to know it's going to be a contested election. It seems like the market is pricing in the fact that we are probably going to know at least less of a probability that we won't know. Let's put it that way, post-election, which I think is nice. So you see a lot of juice getting priced out into 2021 and beyond. That's not good for anyone. It's not good for the country. It's not good for the market. It's not good for anything. We want to at least know what the outcome is. So hopefully Meets, we won't see that. If we do get a bit of a surprise, though, like we did in 2016, I think you can expect to be in for a little bit of a turbulent ride. Hopefully nowhere near as long as Bush-Gore. Hopefully we get this thing stamped out. We have some experience now on that front. I don't think we'll have those, dimpled chads and hanging chads and up and down, massive swings with every little breaking bit of news. So I'm going to lean Mr. Meets or Mrs. Meets that we're probably not going to see that, and that will probably have a outcome. But again, tune into our live election night special. We can all analyze what's going on in the vol and in the after hours together there on the show. All right, next up, Inze, I-N-Z-E. I don't know, pronounce it how you will. Inz. Let's go with Inze. Sounds more fun. He says, hey guys. Another exclamation point. People like exclamation points today. Love the episode about rolling covered calls. That was just a very recent episode we just did here on Options Bootcamp. He goes on to say, I always roll when the stock gets within 50% of my strike. So using your example of selling the 110 XYZ covered call, I would roll when the stock gets to 105. What do you think of that approach versus rolling when it gets to the strike? Also, what is your favorite setup for a covered call? I typically go 3% to 5% out of the money, but I've been reading more about selling at the money covered calls, and I'm considering trying those. Is it worth it? Third question. He's got a bunch. Also, I left you guys a 5-star review. Oh, well, thank you very much, Inze. Hope I got your name right. Seemed like the least I could do for all of the free education you send our way. Keep black hatting it. Well, we will here, Mr. or Mrs. Inze. Thank you for the review. Thank you for your question as well. Dan, this gets back to what we were just talking about on our last show, when to roll a covered call. The listeners asked for that. Nay, they demanded it on the last episode, and we delivered. We outlined an example. He kind of points it out here. We like to use XYZ. We talked in our example about rolling when it got to 110. I do believe that's part of your smart income system, is rolling when it gets to the strike. He likes to roll when it's 5 points away. To each their own. There is no right answer. I will say this. If you are doing that, remember, at the end of the day, the lion's share of your gains, if you go and use any analyzer, any back tester, you go ask, Matt at Orats to run his back testers for any covered call strategy you want and any underlying you want. The lion's share of your gains isn't going to come from the income side. It's going to come, if you want to outperform, from the appreciation of the underlying. So if you are rolling them when you're getting closer, then you are going to cut that off a little bit. So just bear that in mind. If you let your stock run a little bit more all the way to the strike, without messing with it and getting involved there, then you may have a little bit of better performance in the long run. But again, there's no hard and fast rule. If that's what your risk tolerance tells you, that's what you're comfortable doing, then by all means, if it's working for you, Inze, we don't want to change you. 3% to 5% out of the money, that's a typical range. People usually tend to be comfortable that way. Again, and maybe in this environment, if you're a little bit more bullish, at the end of the day, you are owning the underlying. You want to get something for that. And so you want to give yourself a little bit of room to run on the upside. So maybe you can argue a little bit farther out of the money these days if you think there's room to run, or as your approach at the money covered calls. People like that. Some people like to even go in the money. Now, obviously, the challenge with at the money and in the money covered calls is you are effectively immediately clipping any upside there in that covered call. So getting back to what I was saying earlier about how the lion's share of your gains in your covered call comes from upside appreciation, you're not getting any of that. So if you're going to sell at the money or in the money covered calls, you better be happy with the income stream you're getting from that, because that's all you're getting. Now, if it's a healthy and a juicy income stream and you're okay with it, then yeah, go for it. Remember, if you go a little bit in the money, then you're also getting a little bit of that extra juice that's priced into that put wing in most equities. They're going to be at a higher implied volatility level than the similar distance out of the money call strikes. You should get a little bit more juice, a little bit more bang for your buck. So that could maybe help to offset some of your lack of capital appreciation. But at the end of the day, most of the data you're going to look at says, I mean, doing covered calls, it's the appreciation that makes you really smile at the end of the day. Dan, a lot of questions here from Inzi. What do you think of their example of rolling at 105 instead of at the strike like 110 like you have in your example? B, what is your preferred setup? And then C, third part of the question, what are your thoughts on an at the money covered call? A lot to unpack there. So.
Yeah. Inzi is breaking our rule of giving us too much text in questions. By the time I answer the first question, by the time we get to the last question, I forgot what the first question is.
Dan has the attention span of a small child, listeners, so to bear that in mind when you're sending your questions in.
Yeah, now what were we talking about, Mark?
I think we were talking about gold mining in Brazil.
Oh, yes, that's right. So let's see here. I mean, as far as rolling before, like long before it gets to the strike. Well, I mean, first of all, if you're selling 5% out and the stock's at like 100, 105 is 5% out. So you wouldn't be selling the 110 strikes. 105 would be at the money. So you wouldn't be getting out then. So I don't know. It's just kind of, reading through the example here, it's a little bit of a weird example, but let's say the stock was at 100. I mean, I don't know. I prefer to wait until it gets to the strike, but I mean, I am a big fan of you having your own rules on that, whatever works for you. Waiting until it gets to the strike works great for me. But, I always like to say having a bad plan is better than having no plan. And you've got a plan that might work great for you. So, don't let me change your mind on that. The one thing I will say, though, as far as going 3 to 5% out of the money, like that's so arbitrary. I mean, some stocks move 2% in a day typically, and some stocks move, 0.3% in a day typically. So benching it off 3 to 5% is just kind of weird, like it's not really apples to apples. So, I mean, I don't know. First, we've talked about this before. First, in this MTM Smart Income System, we set our objective. Do I want to get assigned or do I want room to run, like Mark was talking about? If I want room to run, I sell it as far as I think the stock can get, which may coincide with the resistance level. But as far as I think the stock can get without getting assigned. If I want to get assigned, then I'll sell closer and I'll just take in more premium. So I answered a lot of the questions. I forgot the other ones. So that should be a pretty good starting point. And if you have follow-up questions, Inzi, you know where to find us.
Yeah, and Inzi, send us a detail, like what underlying you're looking at. It could help us give a little bit more outlook. Obviously, we're just talking X, Y, Z here, but obviously your outlook on the underlying will also help choose the strike. If you think this thing's headed, sideways for a while, maybe even trend down a little bit, you're much more comfortable selling an at the money or indeed an in the money strike versus your outlook of, let's say, a Tesla is going to go up 30% in the next month or two. Then maybe you want to give yourself a little bit of room to the upside. So that also is going to factor into your strike. But if you're comfortable doing what you're doing, don't let us change it. There's no real, this is the only way to sell a covered call. This is just a way that's simple and easy for people to replicate who are new to options, which is why we discussed it. But your way, if you're liking it, go to town. All right, more covered call questions, Dan. People like covered calls. Ezekiel wants to know, I sold an October covered call on everyone's favorite, Bed Bath & Beyond. The stock is now through my strike, but I still see the call and the stock in my account. Is this an error with TD? I thought my stock would be sold the moment the stock crossed through my strike price. Thanks for this great show. Well, you're welcome for this show, Ezekiel. It's for people just like you who have questions just like this. So you're out there. Sounds like you're listening to the show. Maybe you're starting to learn a little bit about what covered calls are. Maybe it sounds like you're doing them in your TD account. So congratulations there on making that first leap, becoming an options trader out there, not just trading stock, That's a nice graduation we like to see in our listeners. Now, yeah, I could see your confusion. Covered calls are not an instant thing. You said October. I'm assuming by that you mean the regular monthly October, in which case you got a little bit more time. Expiration Friday. Remember, it's not here yet. So the regular October expiration right now isn't for a few more days. And then, of course, I think this question came in a few days ago, so I'm assuming you meant for this coming expiration here. So that's why you haven't seen these calls and the stock go away, because the option hasn't expired yet. Now, if this same scenario persists through this Friday, through expiration, and then now you're going to see what happens after expiration. The stock's going to close. You don't say what strike you are, but let's say the stock is $5 past your strike. In this case, what you will see is through the weekend, you're going to see that settlement process go through, and then your call will go away and your stock will go away at that strike price that you sold the option at. So it takes a few days for that to settle out of your account after the options expire. That's the key. Your option hasn't expired yet. So you could, if you wanted, go close this out right now. If you are, for some reason, we just talked about rolling. If you're not comfortable with your stock getting called away, remember we said in our episode last week, you probably should be. That's a win. You should be happy with this. But if for some reason you're not, you could take it off and roll it in the manner we discussed last episode there, Ezekiel. But yeah, you're not going to see your calls go away. You're not going to see the stock go away until expiration. So bear that in mind. It's not an instant thing. The second, because think about that. If the second it crossed the strike, the stock was gone and the option was gone. What a weird product that would be. That would not be that reliable. It could just tick over by 1 cent and it's all gone. That would be certainly disruptive, I think, to a lot of people. You have to have a set term structure, a set time to expiration. That's what options give you. So take advantage of all of that. All right, next up, a non-covered call question. Our first non-covered call question here. Dan, this comes from Machi. Hopefully I'm pronouncing that right. Machi. Machi wants to know, there was listener's question from episode, this is a comment. There was listener's question from episode 102. I believe that was our episode on gamma scalping, I do believe. He says, on options quiz exercises, I'm using Options Reader Workbook by a guy named Jeff Augen, suited for both beginner and advanced. It will make you think. I don't have any association with the above. I'm like other newbie options traders struggling to find good quality content in options. So yeah, I think we did have a question about that, quizzes. So if that's one you like, maybe check that one out there, listeners. The suggestion from Machi, a book on options quizzes. He says, final feedback. If host conversation can be in slow pace. Good show. Please keep it up. Sounds like Machi, maybe English not his first language, but I'll probably take the blame for that last one, Dan. Dan, you can say many things about Dan. Fast-paced, probably not one of them. But me, I get a little bit excited when I'm doing the show. We're talking about a lot of fun topics, having fun. Sometimes I can get ramped up to 11 here. So I'll take that feedback from Machi. I'll try to slow it down for you to make it easier for you to understand. But thank you for the comments. Good show. Please keep it up. We will. Dan, anything to add here for Mr. or Mrs. Machi?
Yeah, don't mix the Adderall with the coffee.
Yeah, and the cocaine. Yeah, I got to stop doing that before every episode.
Oh, no, that's still okay. But, just don't mix those two.
Oh, just the other two. Okay, I see what you're saying. That's the old school SIBO way. You're right. Cocaine's fine. Everything else, not so good. All right, let's see. Moving on from that. Next up, I like this handle, Farmer's Tan. What are all these Robinhood traders, what are all these Robinhood options traders really trading? Are they making money? Well, there's a whole cottage industry now here, Farmer's Tan, of people going out and actually starting to break down the reports. Robinhood's starting to disseminate this information kind of for the first time this year. So people are starting to get a glimpse into what the heck is going on. And what we're seeing is a lot of call love in a lot of the popular names you might suspect, your Apples, your Teslas, your Facebooks, all that kind of stuff. One lots and things like that. But still, that's what we're seeing out there. In fact, we were just talking on one of our shows recently, again, with Matt from ORAT, so he keeps a lot of this data and analyzes it. And he says, very recently, I think up until last week, I don't know if it includes this week's data, but he had never seen the call skew as pronounced as bid in Apple. And ever since they've been running this data as it is now. And that's a lot of that reflected by this retail explosion, and it's predominantly in the calls. Not a lot of put love. I think we have a listener question about that in a little bit, so maybe we'll get to that in a little bit as well. But yeah, it seems like these guys and gals are buying a lot of calls on big name tech stocks. Are they making money? Well, in the V-shaped recovery, they probably did. This thing obviously aggressively rallied. We saw some pretty high vol levels, so they had to pay for it. But if they traded judiciously, maybe started using some spreads and things like that to minimize their outlay, and they listened to a show like this, then hopefully they did. If they're out just willy-nilly buying crazy far out-of-the-money calls, lottery tickets effectively, that's going to be a little bit more difficult prospect right now because things are a little bit more turbulent right now. Not quite the straight-up trajectory we had post-March in the marketplace. So are they making money now? That's probably more debatable. But they probably did all right in later Q2 and into early Q3 probably. Mr. Dan, what are your thoughts? Do you have any of these Robinhood folks come your way, sir? If so, what are they trading?
I don't have any insight into what Robinhood folks are trading, but I suspect that just anecdotally, I have heard that they're reasonably simple strategies, that there's maybe not as much sophistication as there is at some other brokerage firms. And that said, I mean, everybody just keep in mind too, like we're all playing our own game, like there's millions of people trading. And if we analyze something and do a really good job and get good at trading, we can make money, and it doesn't matter if anybody else in the world makes or loses money. We're always just playing our own game. That being said, I mean, I guess at the heart of the question is just, I wonder. So, yeah, I don't know. I mean, I would suspect that they're fairly basic strategies just from people I've talked to.
Yeah, they're pretty much just buying all the money calls. It's about as basic as it gets. And yeah, these days maybe a little bit more challenging, but it did work out early, and then we saw that, a little bit more difficult road these days. But hopefully they're coming in, they're learning about options more. They're not really learning much on options yet at Robinhood. They kind of are working on upping their educational offerings there. Hopefully they will soon. Some of these folks can learn some more advanced strategies from there, but they are diving in large numbers these days, larger than ever. All right, next up, Michael Smith. He says, I'd love to hear you guys break down using options to forecast dividends on Options Bootcamp. Lots of movement up and down with COVID on that front. I just find it a little confusing. And it shouldn't be. No, I don't think you should be down on yourselves at all, Michael. These are very confusing times. And the dividend flows for companies right now are terribly confusing. We've seen everything come out of companies right now is terribly confusing. The earnings. So if the earnings are a question mark, the dividend flows and the reliability of those dividends are also going to be extremely confusing out. That's one of the things I've been talking about for a while. We've been crunching the numbers there for all year in terms of earnings volatility, earnings straddles, and I've been amazed at how little data we're getting from these firms on the earnings front, on the dividend front, and yet the vol is coming in on some of these names. And certainly not meriting the large amount of vol they're pricing into these earnings straddles. So I've been as surprised as you are, Michael. I wouldn't beat yourself up about this. This is the challenging thing. That said, Dan, this is kind of an area of options. This is where I like these questions. They take us in interesting areas. This is an area we haven't really talked about much on Options Bootcamp. I know it's hard to believe. We've done the show for a while. There's still areas we haven't mined in depth, but the interrelation of options and dividends is one of those areas, let alone the use case of options to forecast dividends. So, Dan, maybe we'll start there. Maybe give Michael and maybe some of our other listeners a little bit of a breakdown of the relationship between options and dividends. And then if you have some thoughts on using options to forecast dividends, particularly now in these tumultuous times, have at it, sir.
Yeah, it's an interesting question, actually. Good one, Michael. So as far as options and dividends, what's important to understand just at the heart of all of this is that if I own shares of stock and the company pays a dividend, I get the dividend. If I own a call and the company pays a dividend, I don't get the dividend because the call is just listed by an exchange. It kind of has nothing to do with the company. So that said, before the dividend, because I can exercise my call to get the stock and then consequently get the dividend, the price of the call factors that potential exercise in. And then after the X date, which is when you have to be holding the stock to get the dividend. After the X date, then the call and the stock are sort of on the same playing field as far as the dividend goes. And so the price of the option relative to the stock adjusts right after the X date. Okay, so that's sort of the background that we need to know. Now, when market makers and other professional option traders are running their pricing models, what they do is they estimate what the future dividend stream is likely to be. And, we just did that based on past dividends. Like, oh, look, for the last 4 quarters, they paid 43 cents. And then the past 4 quarters before then, it was 41 cents. Past 4 quarters before then, it was 39 cents. Oh, they raise their dividend by 2 cents every year. Okay. And then we just factor that into future dividend stream. So, it's kind of tail wags the dog. Like, you can do the same thing that the market makers do and just see what the dividend history is to try and predict the future. But, in a time like now where there's a lot of stocks that are trading at 50% to what they were trading at a year ago, professional traders and you kind of have to estimate that yourself. So, could you theoretically look at the option prices and get a glimpse at what maybe market makers and other professional option traders are thinking? Yeah, maybe kind of, but it's tough because, there's, the interest rate they're using, American exercise comes into play. It's kind of tough to back out that information out of it, but I don't know, it might be something possible. I kind of answered a lot of areas there, but
it's an interesting question. It's not really, the use case I put options out there for, because you're right, it is such a challenging thing. In the past, dividends were one of the more stable and reliable inputs to the Black-Scholes model. That was one of the things you could rely on. Usually rates were everyone had the similar rate, maybe a little bit of a difference here or there, but they had a similar ballpark on the rates. The dividend was something you could reliably stick into that model. Everyone had the same dividend. And then other things like volatility would start coming into play, and you could have some fudge and some fun with those. But dividends were a reliable input. These days, as you point out, Michael, not so much. So if there is a name and you think maybe they're going to change their dividend up in the near future, you start looking at the term structure of those options. Maybe you go out a month or two, wherever you think this dividend change is going to happen, and you don't see that reflected in the options prices as a result. Remember, taking away that dividend has a lot of different impacts. So maybe the market makers don't think it's happening or they haven't priced it in yet. That could be an opportunity. But seeing options market makers, as Dan pointed out, aggressively pricing in taking away a dividend really before that's announced, you're not going to see that too often out there, because that's a rough road and it's a difficult way to go. You don't have any confirmation of that. So you're taking out a core reliable input from your model for something that is maybe less reliable. You don't know. So I don't know if this is a use case I would leap to for options. Usually I say options are usable for a lot of different things. Using them to forecast dividend changes is not really a reliable thing, because market makers are kind of reticent to do that. Maybe you might see some big customers coming in thinking that's going to happen, and maybe they start crushing, the vol on one of these terms because they think this dividend component should be taken out. You might see some of that. But in general, usually it's a bit of a lagging thing with the options. When they cut the dividend, then you'll see that reflected out there, and not usually before that. So using it as a good forecasting tool, probably not the best use case for options. But a good question, a great question nonetheless. And I'm sure we're going to have a lot of different related questions on this theme going forward. So maybe something we can return to on a future episode and kind of explore the impacts of dividends, maybe some of the use cases. And what do you think, Dan? Maybe a good topic for a future episode, sir?
Yeah, that could be a really good one, Mark. I like that.
All right. So there you go, Michael. You've inspired perhaps a future episode here of Options Boot Camp. Here's one I kind of touched on this earlier. This is related to a listener question earlier. Nicholson wants to know, why do you think so many people make their first options trades in calls versus puts? Yeah, this is a well-known phenomenon. Hey, we're seeing this now with Robinhood, right? They're mostly flocking 90+% or so into the calls, not a lot flocking into the puts. I think there's a couple of reasons for it. First off, people are generally, when it comes to equity markets, naturally bullish, longer term in particular. So they're going to come in, they have an outlook on underlyings that they think are going to appreciate. They don't usually, there are a small subset, They usually call them short sellers who think the opposite way. But 90% or so, let's just throw that number out there, tend to be in the bullish camp. And that's how they look at options, particularly when they're first coming to options and making their first trades. I am bullish on whatever. Apple, Tesla, SPY, whatever the heck it is. I would like to express that viewpoint using options. How do I do that? I'm going to buy an out-of-the-money call. That's usually how the game gets started for a lot of people. Then they start mixing it up. They start saying, well, maybe I want an income component. Maybe I'm going to do a covered call instead. And they start learning additional layers, additional wrinkles. But very few people think in terms of puts because it's kind of an inverse relationship, right? They're not thinking, I think the stock's going to drop. Therefore, I would like to buy a product that allows me to sell this underlying at a future date. There's just a few layers of abstraction there with puts that aren't really there with calls. And so people usually have to get a little bit more acclimated to the product before they can really start wrapping their heads around, hey, I can use this product to hedge and use it to speculate on downside. It's just not a natural psychological way most people look at the markets, particularly in the audience for a show like this, your basic introductory retail trader. They don't look at it that lens. They don't look at it in the inverse short seller viewpoint. They look at it from the bullish optimistic viewpoint. Dan, would you agree with that, sir?
Yeah, I'd 100% agree. I believe that there is one single answer for it, and that's it. I think like if you were an alien coming down from space and needed to try and figure out the answer to that question, like there are a whole bunch of things that you could try and justify as the answer to that would make sense. Like, the market has a greater chance of going up and down. Calls tend to be a little bit more liquid, higher volume, tighter bid-ask spreads than puts, blah, blah, blah. But there's one single answer, and it's because that's just how most people's brains work already from their past experience by the time they get into the options market.
Well said, sir. Good question, though. Nicholson, next up. I got good handles today. Sevastopol 6. It sounds like a spy's call sign out there. Sevastopol 6 says, I've heard you guys say that being a market maker was the best training on the planet for really understanding how options work. Why? What made it so good? Well, I do stand by that. I think it is pretty much the best way to learn how to trade options. Unfortunately, for a lot of you guys out there, it's not really a route that's accessible any longer. When Dan and I were coming up in this business, you could come out to Chicago like I did, and pretty much was Chicago. There were some areas you can do the Amex, you can do the Pecos, a few others, but pretty much it was Chicago, and you would find a whole host of firms that were willing to train you up and spend money to do so and also pay you to learn. Not a lot. When you were a clerk, you really didn't get paid a ton, but you were given the implicit promise that down the road you would make a lot more to make up for that. And they would, of course, train you. When they thought you were ready, they would put you on a badge. They would pay for your badge. They would provide the capital for you to trade. And that was kind of how you got started on that road. The analogy I've often used is it's similar to, immersion training to learn a language. And the best way to learn Italian, French, whatever, is to go to that country and just immerse yourself. And if you're surrounded by it 24/7 and you kind of have to sink or swim to get by, you're going to get better. And market making was very much that. Imagine, being a young kid just kind of thrown into one of these enormous pits like the SPX back in the day, and you kind of literally had to sink or swim. You were surrounded by 100+ other people out there, usually men, usually kind of surly men, usually guys who didn't want you there. So it made it that much more fun from that perspective. So if you could survive and learn in that environment, you could really do it anywhere. And of course, you had positions that were being thrown at you all day long, positions you never wanted and never sought out. So you had to figure out, along with everyone else around you, how to make money hedging and spreading off these positions. So it was just a constant immersion, constant exposure to seeing how the Greeks really worked, how all these things really worked in real practical environments, all the while being completely immersed in this environment. It's just not something you can really replicate, or it's very difficult to in the modern world. Dan, I know this is your viewpoint as well, that kind of training. It's kind of hard to match. What are your thoughts here for the creatively named Sevastopol Sticks? Why was that pathway to learning options so good?
Yeah, a couple of things. One is, like, when you start out, you're trading somebody else's money. Like, whenever somebody ever went down to the trading floor and they were like a rich kid and their dad gave them $250,000, like 3 months later, the $250,000 is gone. Like, you always start out as part of a firm or having a backer, and that firm or that backer, they want you to make money. And so first of all, you've got a built-in support group. You've got a team of people behind you who are training you. I'm sorry, but no one has ever learned to trade options on their own just from tooling around, and the second half of that kind of relates to that, back to Mark's immersion idea. The market is the most expensive teacher there is. And if you're only making 1 or 2 trades a week and you lose money on one of those trades, the money's gone, but the market doesn't tell you what you did wrong. It just takes your money and you're there to try and backfill some answers. And how do you know? You don't know. So, A, having that support group behind you, and then B, making literally 20, 30 trades a day on a regular basis. And like Mark said, trades that you probably wouldn't plan yourself, they just throw weird stuff at you and you've got to figure out what it means and how to manage it. You can't not get good, I'm
just looking here. Who was the guy we were just answering his question of, Michael Smith, he had the dividend question. He was listening live. He said he caught the end of it. He says he always downloaded it. He said, we sound much different, Dan, than at the 2.5 speed that he usually listens at. So I guess to him, we sound like Mickey Mouse.
Yeah.
So I'm glad to hear that you actually heard the real sound of our voice for a change, all you out there. I've never been a faster speed podcast guy. I don't know. I like to hear my podcasts in their native format. But hey, to each their own. We don't judge here. All right, next up, EMC. EMC wants to know. He's got an interesting question as well. People seem like they have leaps on their brain these days for some reason too, Dan. He says, I was just looking at some 2022 calls. Okay, it's a bit of a ways out. For something like Alibaba. Excuse me. Right now the price is hovering close to 300. But what if it hits, this might be a Robinhood trader. What if it hits 2,000 plus in 2022? Will 2022 calls I can buy right now for $40? Are the 2,000 calls trading for $40 in Alibaba? Well, I'll have to go check those. Will the 2022 calls, easy for me to say, I can buy right now for $40 even be available to be sold? He's not a Robinhood guy. He's a Webull. Looking at Webull, you'd never see a $200 call listed even if the price is 2,000 plus. I'm not sure what he's getting at there. But I guess at that point, you can just exercise it if you had the money. But how would you sell the contract if you wanted to? All right, there's a lot to unpack here. First off, that's a very optimistic price outlook for Alibaba. Hey, we've seen crazy things. This is the year of 2020. I'm not going to say anything is impossible, but that's a pretty aggressive run. Going out and just paying $40 for calls that, let's see, where is Baba trading right at this moment right now? So we can get it. It's 303. So it's $3 higher than where he sent this question in. So you're expecting this stock to appreciate $1,700 in the next, year and change. And you're willing to pay $40 for the privilege of have a seat at the table north of the 2,000 strike. Yeah, I would encourage you, EMC, if this is your first episode you're listening to here, go back into the archives and really start listening from episode 1 because we explain a lot of this. Maybe we'll talk you off the ledge and start explaining some maybe higher. This is effectively a lottery ticket you're talking about here, not our preferred use case for options. There's a lot of things you could do. You could probably take that same outlay, move it a lot farther down the strike chain if you are indeed so bullish, and get a vertical for a similar outlay that probably has a much higher payoff probability. There's many different things you could do, much better than just loading up on a complete. $40 is still an expensive option. You're not talking cheap money here. You're talking $4,000 for a one lot. Is that really what you want to spend your $4,000 on? I think you have better potential options, pun intended. And yes, if, let's say in your scenario does come to pass, this thing explodes to the upside, your $2,000 calls are now trading for, I think you say $200. How would you sell it? The market is there. That's what the OCC is for. OCC will be the backstop, the counterparty to all of your trades. So if you buy an option, I can guarantee you there will be someone there when you want to sell it. It may not be a market you like, maybe a little wide, but there will be someone there to take the other side of that. So I would not worry about that. And you can exercise it. So if that's your goal, but at this point you've held on to a call that's gone from $40 to $200. Maybe you want to sell that thing. You have a lottery ticket that actually worked. I would sell that thing. Dan, what do you have to say? There's a lot to tackle here in this many-part question from EMC.
Yeah, I mean, the key takeaway, just getting to the heart of the question, is they never delist strikes. Like if you traded it and there's volume at that strike, like they're never going to delist it. So don't worry, it'll be there. I mean, if it's that far away, rest assured, the bid-ask spread, you'll be able to drive a truck through, but it'll still be there,
Yeah, there's a lot to unpack. Go back to the archives and maybe call up a guy like Dan. He could set you straight here. All right, let's wrap it up with this one more. This is your favorite questioner here, Dan. This is Baiju. I think he's the guy who you thought was named after a Chinese liqueur. He says, "Hey, Mark, thanks for answering my questions." He has written into Boot Camp once or twice. He says, "Here's one more. What are your opinions on clients who play the last day of options expiry to collect pennies on selling options? What do you think of the strategy, and do brokers even allow this kind of trading, knowing the extreme risk? We do hear stories around VIX products sometimes being affected due to this." Well, the latter portion I'll start with. I think we touched on something like this on vol views recently too. The big brokers, a lot of brokers, the more savvy ones like IB and others, they will limit you in terms of products like VIX in particular. IB is very draconian when it comes to what you can and put on around settlement and things with VIX because they've been burned in the past, and they have all sorts of exposure fees and other things. They kind of want to disincentivize that type of flow on their platform. Other brokers are a little bit more lenient. Others are kind of newcomers like the Robinhoods and Weebles. They probably don't know any better yet, so they don't really have those types of exposures. So in general, some of the brokers that have been around for a little bit longer, they may have a little bit different rules of engagement, particularly around products like VIX and particularly around the settlement time there. In terms of the other thing, the collecting pennies, selling options right before expiration, I've said this before, there used to be guys when we were on the trading floor who would do this. This was their life. They would come in, you'd see them once a month, because back then expiration was once a month, and they would show up for that one day. Maybe the day before Tuesday, maybe 2 days. And that was it. And they would try to harvest all their premium they could. It was a pretty rough go. You'd see these guys popping tums. They were sweating because, the short premium theta decay game is a rough one. You got to sweat it to make money. But if you're okay with that, that's what they want. But we used to call that, picking up pennies in front of a steamroller. Eventually that steamroller comes to get you. And it's a difficult, dare I say, dubious way to make a living. That's why we don't talk about it here on the show too often, selling penny puts. Mr. Dan, what do you have to say here for your favoritely named listener here, Baiju, and selling pennies on expiration to collect, or selling puts that are trading for pennies right before expiration?
Yeah, that's mostly professional traders doing this, and when there's professional traders, everybody has a niche, and there were some who did that, but I think most of the volume you see trading at pennies on expiration day is market makers who were long those, just trying to close them so they don't lose pennies times thousands. Or market makers who were short them, who need to buy them back so they don't have the gamma risk. I think you'll find those are mostly closing transactions. So, the one piece of advice, as far as being a retail trader, leave that game up to the pros. That's a silly game. Picking up pennies in front of a steamroller is, that's a phrase we can use for a number of different option scenarios. This is that amplified times 10. This is I don't even know what the analogy would be, picking up pennies in front of, I don't even know what, something worse than a steamroller. a big speeding bus. How about that? That's bearing down on you. Right. And I would point out, too, people think this is a free lunch, just getting these pennies. But, of course, your broker's still going to tie up the margin for all those puts that you sell. So there is an opportunity cost to this. And if you have a cost, you want to make sure your reward for that is going to offset that. And a couple of pennies, is that going to offset all the capital you have to tie up for whatever puts you're selling and whatever name is going on out there? So, yeah, Baiju, this is not our favorite approach out there. Good questions from all of you. Dan, that music means we've come to the end. Unless, of course, you've had any interesting and or burning questions come across your mentee desk of late that you want to share with our audience. If so, sir, have at it. Now is the time. The floor is yours. Oh, geez, I don't know what questions I've been getting asked lately even at all. I did have one of our students request that we spend one of our one-on-one coaching sessions, which we've been doing a lot of lately, specifically on when to take profits on neutral time spreads. And the reason I suggest we do that in one of our one-on-one coaching sessions is because there's a little bit of a long answer to it, but I'll kind of give the Cliff's Notes. It's definitely situationally dependent. I love scaling out, if you have on multiple contracts, if you put it on a 10 lot, I love taking off 5 at, maybe like a 15 to 25% profit target. And then maybe the balance at a little bit more, 40 to 50% of what you paid for it. But, I like to caution, you've got to be a little bit greedy with time spreads because the potential's there. If you structure them properly with good term structure and the chart makes sense and it meets certain criteria that we have, you can get a really good leverage profit. So leaving money on the table is highly unadvisable with anything, but especially with the time spread, because when they go against you, you can lose, 15, 20%. So you don't want to be in a game where, you can make the same as you can lose. You always want to be able to try and make more than you can lose. So hopefully that makes sense. But that was a question that I got this week that I thought might provide a little bit of value for our listeners.
Folks seemingly have endless questions about time spreads. I get it. I've often said time spreads are your options 201, maybe even your options 301. When do you put them on? How do you take them off is a common question. Do you take them off as a unit? Do you take them off one leg at a time? Do you use one leg to maybe finance the other? A lot of different ways people have confusion about time spreads, witnessed by the many questions we've gotten about them on all the episodes we've done. If you too have questions about time spreads, listeners, check out our archives. We've done 1 or 2 or maybe many more episodes about time spreads there. But great job, Mr. P. Great job to all of you out there with your questions. We could probably spend another 3 hours answering your questions out there. You have so many. Keep them coming. You know where to find us at Options, most of the major social media platforms. You could leave them wherever you listen to these shows, but those are usually more for the reviews there. If you want to have a timely question, hit us on the other platforms, including questions at the optionsinsider.com. That also works. Or use our mobile app that has the feedback function in there. If you want to get in live, you can always, if you sneak in when we're recording this live, you can always bump to the top of the list there as well. But before we go, Mr. P, if someone wants to reach out to you, maybe they also have questions about trading time spreads, or maybe like others did about selling penny puts, or maybe they want to buy crazy leaps and far-off equities, where should they go? What should they do, Mr. P?
Yeah, hey, surf on over to our brand spanking new website, markettaker.com. And we would love to have you come and ask us a question. You can go down to the footer and click on one-on-one coaching if that's something you've been thinking about. We'd love to have somebody from our trader success team give you a ring and see if it's a good fit for you. No pressure. They'd love to chat with you. So yeah, we love talking to traders and trying to help them live their best trader life.
There you go. Live your best trader life. I like the new tagline over there at Market Taker. Check it out for yourselves. The brand spanking new website. Only took them about 14 years to get it right for you, listeners. Head on over there. You get join free. There's a memberships tab. All sorts of good stuff and a lot more. MarketTaker.com. Don't forget the second T, so you too can begin your journey over there. On behalf of the black-hatted one, Mr. P, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in your questions, for leaving your reviews, for all the great stuff that you do. Keep it coming. We feel your love, particularly on a show like Boot Camp. You guys are really just mainlining it these days. We love to see it. So if you have a question, hit us up. No question is too outlandish, as you see from what we got here today. And we'll see you back here throughout the rest of the week. Remember, OPR is coming later today. You'll get that in your podcast feed pretty soon with Brian answering some of your questions, talking about some fun topics over there. Tomorrow we're back with TWIFO, This Week in Futures Options, as well as episode 2 of the option block for the week. And then Friday it comes home with volatility views all the way through into next week and another episode of Options Boot Camp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.